Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, November 15th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is global liquidity and by extension asset markets rolling over? Our answers are, in a word, yes. Whether or not the current pullback in global liquidity materializes into a deep correction depends on how effective U.S. policymakers are at toning down dollar strength over the next couple of months, if at all. That is because the Dixie's bullish Vans breakout from a month ago is the dominant driver of the negative trend inflection in global liquidity signaled by our macro weather model today. We know because our positioning model has recently identified the U.S. dollar as the dominant driver of global liquidity at the current juncture, as well as the RRP. Dollar strength is causing the PBOC to actually tighten liquidity conditions to support the yuan, despite announcing hundreds of billions of dollars of fresh monetary support just 2 months ago. It would seem that the first round of trade negotiations has begun even before Donald Trump takes the Oval Office. Beijing may be forced into brokering a Shanghai Accord 2.0 in the coming weeks if they deem themselves unable to wait until the likely $700 to $800 billion of dollar bearish Treasury General Account spin down in Q1. All told, we remain fundamentally bullish, but our core risk management signals are on the verge of selling across a variety of risk assets and macro exposures. Amid all the crypto bro euphoria on Twitter, investors better proceed cautiously amid the post-op X window of weakness. Alternatively, 42 Macro clients can continue to invest stress-free, knowing they have access to clear, accurate, and affordable buy and sell signals like KISS and Dr. Mo, which obviously you're not going to get unless you're on this side of the paywall. So transitioning to our 42 Macro dashboard, we'll wrap up with our question from our community. This one's regarding the 3-month and 10-year Treasury yield curve. It says, "Hi, Darius. I've been on board at 42 Macro for 3 months, and it's clearly the best investment I've made. Thanks for all that you and the team do." So thank you for the kind feedback. We appreciate that. Pretty consistent with our new subscribers, and we were grateful for that because we're working hard to generate some very positive outcomes in our client portfolios. So the question reads, "It appears that the 3-month 10-year yields are getting ready to uninvert. Does this cause you any caution? Is this something you consider worth tracking? Or is this just one of many factors to weigh that maybe some people overweight due to its historic correlation with recessions?" So the answer to these questions, so let me just answer questions in order. Does this cause you any caution? No. The uninversion of the 3-month 10-year Treasury yield curve is consistent with where we've been with our resilient U.S. economy theme since September of 2022 and our sticky inflation theme since January of 2022. 2024 has been about both the Fed and investors broadly coming around to where 42 Macro has been for the past 2 to 3 years with respect to nominal growth, dynamics in the U.S. economy. So, of course, we're expecting the 3-month 10-year Treasury yield curve to uninvert in the context of our Bayesian Bayesian inference process that has consistently signaled a low probability of a developing recession in the U.S. economy since we authored that resilient U.S. economy theme over 2 years ago. So the inversion has already been sort of foretold by, if you look at other dynamics in the bond market, one of the things we track is the adjusted 10-year Treasury yield, which is adding back the deviation from the mean level of term premium that we've observed in the bond market over the past 60 years. And the 3-month 10-year Treasury yield curve was actually never inverted. If you actually sort of had a normal, quote unquote, normal functioning bond market. And so what we're seeing now is the sort of unadjusted 10-year Treasury yield, that the one you guys are seeing on your price screens, is now starting to uninvert from the 3-month 10-year, from the 3-month T-bill yield, really just kind of chasing where the adjusted 10-year Treasury would have been throughout this entire process. Another thing we call out is if you adjust the bond market for a normal level of term premium, then you're talking about break-even inflation expectations on the 10-year that are somewhere around 3.5%, as opposed to the kind of low 2s that we currently have. And so that 3.5% is highly consistent with where our secular inflation model has been signaling the underlying trend of core PC inflation is likely to be in this business cycle since going back to when we authored the sticky inflation theme back in January of 2022. If you recall, our secular inflation model was calling for a sort of underlying trend of 3% core PCE inflation, like an equilibrium level of 3% core PCE inflation, which historically, based on the spread between headline CPI and core PCE, you're talking about 3.5% underlying trend or equilibrium level of headline CPI, which is exactly what the bond market is pricing in if it were operating with a normal level, healthy level of term premia. So I think the bond market's got this right. In our opinion, we continue to pound the table on our resilient economy theme, our sticky inflation theme. We've been there for two plus years and almost 3 years, respectively. And again, like I said at the beginning of this, the 2024 has been about every investor being forced one by one to capitulate higher, as we called for in the beginning of the year in January, to capitulate higher into those themes. And we've obviously been rewarded handsomely for that in this raging bull markets. We, being 42 macro clients, and myself, because I use our research to manage all my liquid net worth. So we'll wrap it up there. Darius Dale presenting our macro minute for Friday, November 15th, 2024. Everyone have a wonderful day. Have a great weekend, and we'll catch you back here on Monday. Cheers.